Hello there and welcome to Oil Market Insight. You're joining us here in Vienna at the OPEC headquarters on the occasion of the 171st OPEC conference. Thanks so much for being with us. And we're going to take a look now at the state of the oil market. And I'd like to introduce you to my guests. Joining me now, Bill Farron-Price. Bill is the CEO of Petroleum Policy Intelligence. Thank you so much for taking the time. Jason Schenker also joins us. Jason, of course, the president of Prestige Economics. And we're also delighted to have with us here Gaurav Sharma. He is the business editor for IB Times and also an oil analyst. So, gentlemen, thank you so much for taking the time. I'd like to start with you, if I could, Jason. When we look at the state of the global economy, the health of the global economy, ultimately what's going to determine oil demand. Bring us up to date, and how are things looking right now in your book?
Well, I'd say that generally things have improved, and especially we've seen the second half of the year has been quite good. The Chinese manufacturing PMI, the Eurozone manufacturing PMI, the U.S. ISM manufacturing index, all of these are leading indicators of growth. They strengthened in the second half of the year. So whether we're talking about China or the Eurozone or the United States, things are better in the second half of the year, much better in some cases than they were in the first half of the year. So this is positive for oil demand growth as we go into 2017. We have kind of some mixed outlooks, but generally see growth remaining around 3% for the global economy in 17, but significantly stronger in 2018.
And again, that's exactly what the market needs to drive that growth. When we look at other regions around the world, Gaurav, non-OECD particularly, give us a feel for what you think is going on in some of those regions too, and what will drive the growth.
Well, you see, I would say I'm mildly optimistic. If you look at the big five, i.e. US, Japan, South Korea, India, and China, I'm quite positive on US and Indian demand. Especially in India's case, the demand spreads right across the board to lower distillates as well. But then on the other hand, Japan, the demand is quite weak, ditto for South Korea. And with China, as Jason has just said, it's in a bit of a tricky spot. So overall, in the overall scheme of things, I would say OECD demand has been tepid for a while. So a lot of the exporters would be looking at non-OECD demand. And in that sort of dynamic, it's sort of on an even keel, I would say.
And again, it's that uncertainty that's been in the market. I mean, it'll probably always be in the market. It's the nature of the market. But we are seeing, Bill, prices that have been low for quite a while. And I think we're beginning to hear the mantra lower for longer. And it's sticking, really, isn't it?
Yeah, I think it much depends upon exactly how demand does pan out next year. I take on board everything that Jason said, but there are also some other features. We've seen, for example, Middle East oil demand go down quite a lot over the last year, largely as a result of subsidy reduction in the energy sector. And we also know that Chinese stock building may be tapering off a bit now. And that also could, put a dent into Chinese oil demand growth. So there are some features that are not entirely healthy, but overall, I think it's right to accept the view that it's mildly positive. The picture is of a sustained improvement on this year probably, and then heading even stronger into 2018. I think that's correct. So the question is, lower for longer will depend upon very much how much OPEC can fine-tune supply at the margin to achieve the sort of stock draws that need to occur for more direct transmission of supply policy to work in the global oil market.
When we look at the work that's been going on, particularly coming out of the OPEC Secretariat in the last few months, Jason, there's been a huge drive since the Algiers Agreement to really get consensus in the market. And again, much more aggressive than we've seen before here, bringing OPEC and non-OPEC together. How important is it that we really begin to see this cooperation and this development to go forward to really help drive the market and help, move the agenda, so to speak?
Well, I think we've seen a big change under Secretary General Barkindo in general, where there's a move towards more what central bankers would call forward guidance, right? And this is where you're providing more information to the market. There's the frequency of press releases, the frequency of shared information, all of that has gone up in order to be, at least as I see it, more transparent with the market, to share more information about discussions. But by the same token, because there's been more frequent discussion of things following the Algiers Accord and discussions between OPEC and non-OPEC members, it does raise the stakes a bit in terms of, when, how, could there be an agreement? What does that look like? But I think that this forward guidance does seem to be an effective policy. And like I say, as OPEC is the central bank of oil, this is something that other central banks do very frequently, and it's a highly effective means to help the markets kind of understand what's going on and what could potentially happen next.
Bill, would you say this is something that has to be in place, not just for one occasion, but there's a shift really in terms of the OPEC, non-OPEC players coming together to maybe understand the market, to put more transparency in the market, and just to move it forward, because they can't operate in silos anymore, really, can they?
Yeah, I think that's correct. I think what we've seen is this major development. It hasn't been a smooth road necessarily, but the producers within OPEC and outside it have seen the benefit of better communication, bilateral communication, and multilateral fora as well. And they've seen the market benefit of that. We've seen oil prices have ticked higher this year when we've seen strong communication between the Gulf leaders of OPEC and Russia, for example. And I think that that's going to be a theme going forward to next year. I don't think there is any more a sense that OPEC will act in isolation. I think it will be always a question of trying to draw support from others, if not necessarily hard physical support, then at least moral support.
Do you see this as a shift and as a change that in a way is welcomed by the market?
I think it's a positive development. I think I'd rewind the clock back a good 2 years to the summer of 2014, where we got a tacit acknowledgement about the presence of shale players stateside. And then taking that forward, OPEC has engaged more meaningfully with non-OPEC producers. It's always claimed that it wants to engage with the wider market. Now we see it being reflected. OPEC has acknowledged that it doesn't want to act alone, not that it explicitly stated that it wanted to, but going forward, this is definitely a positive development. How it plays out remains to be seen.
When we look particularly at the shale players in America too, and again, let's take a quick look at the global or the American economy, Jason, perhaps. There's been a big shift, obviously, in policy and politics in the US too, and we'll have to see how that plays out. But, what is the situation for domestic production in America right now?
Well, I think there's a couple things. Obviously, the current price level is less conducive to drilling than it had been. I would say, though, that it's still relatively easy to bring some of those shale supplies online. But again, they're very small compared to the conventional finds that are out there in the marketplace. I'd say that the biggest thing right now that's a challenge is that there had been a mandate, and there still is a mandate on the books, from the Fed, the FDIC, and the OCC, which are the bank regulators in the United States, to really restrict lending into oil and gas in the U.S. So there is a mandated by the Fed credit crunch for oil and gas drillers. So unless you have a lot of cash, your cost of capital has gone up many times over, because you've had to go now, instead of going to the public markets where you would have, or banks where you would have gotten a 5% interest rate on money you didn't have, now you might have to go to private equity and get 25%. So your cost of capital has gone up a lot. So this makes players with lower grades of credit or less access to cash, they're in a more challenging situation, and they're likely to remain there probably for another year or so.
So is funding right across the industry, Gaurav, is it tough at the moment? Because we look at low interest rates and we would imagine actually it's maybe a good time to get funding. Or is it just in America that maybe that's tough?
I think stateside, the question is the private equity funding is there, but the PE guys are struggling to find the right kind of assets to go into. We did some research in Pennsylvania and Ohio and West Virginia, and we found that there were a number of shale plays that are quite viable, quite comfortable at $40 a barrel. But yet at the same time, there is a lot of distress in the market. There are a lot of private equity players who are out there in Houston, Texas, looking for good assets. Some of them are armed with $20 billion worth of dry powder, but they can't find the right asset to buy. So to just sort of have a carte assumption that shale would make it work at $40, not quite right.
But again, I mean, let's take a look, Jason, at the political landscape. I mean, we've got a new president in place. How good will this be for the oil market? Surely he'll be pushing all sorts of activity.
Well, I think it's going to be a mixed bag, because right now, if we look at the fiscal policies that have been proposed, what you'd expect is more deficit spending, which is likely to lead to more growth. You're also going to get tax cuts, which leads to more growth, and all of that more growth leads to more inflation. So that additional inflation could also be supportive for oil prices, right? So if you get more growth, you get more inflation, it pushes up your oil prices. Now, by the same token, the back end of the yield curve, so longer dated treasury rates, there's been a sell-off in that bond market. You've seen those rates, the interest rates go up at the back of the curve. And that means that if you get more deficit spending, right, you have to finance it with more debt, you could see interest rates go up. And that could, again, continue to pose a challenge from a cost of capital standpoint for drillers, but the price of oil could find support from the inflation and growth.
Bill, when we look at, what might happen, it's really gazing in the crystal ball when we talk about the oil market at any time. Yeah. A bit more growth in the economy would certainly help, but we've just seen 2 years of absolute no investment. We're going into a third year. None of the big IOCs are, waving their money around, saying they're ready to get back into huge capex expenditure. So where are we in terms of the dangers of lack of investment? Because it's been off the table for 2 years.
Yeah, it's interesting, isn't it? Because we are seeing that, shale oil has bottomed out and is likely to return to growth in the next year. So there has been a huge cost side adjustment that's taken place in the US. And I think we're seeing that elsewhere as well. Maybe not with quite the speed that it occurred in the US, but it is happening. And the other thing is that the low-cost producers, OPEC producers themselves, have proven that they are very able to bring on new production or to squeeze more production out of existing assets under current market conditions. So, that is the argument for lower for longer, which is that you do get extra barrels coming regardless of the economic cycle and regardless of the oil market cycle.
Has this been a bit of a wake-up call to the industry, would you say so, Jason, in terms of the fact that, and I've done so many conferences, no doubt you've done them yourself, and it really is becoming the mantra. Somebody recently was talking about fit at 50, while somebody said we might, see fit at 50, but we might never be happy at 100 again, and that's almost the reality. But, has it really woken the market up to see and prove to themselves they can be a lot more efficient and produce better?
Well, I think there's two things. There's the OPEC side, which is the operating costs. So those have fallen, and some of that is, now it's more, if you're a driller, it's a buyer's market, right? So you can pressure some of your vendors, and now, you might have a better profit margin. But again, if you're financing that with debt, your cost of capital went up 400%. So unless you had an 80% drop in your drilling costs, if you're borrowing money, it's still more expensive for you to get those marginal wells. So I think that's one thing. I think as we look at a wake-up call, I think, there's always in places like Houston and Texas, and as there are in OPEC countries, there's always a concern that a drop in oil prices can have a negative impact on the economy, can cause a slowing of growth. And I think everyone's already well aware of that. But the underinvestment, that massive pullback that you just alluded to, rolling into a third year of this, presents significant upside price risks to oil when we look out 3 to 5 years.
What are you hearing, Gaurav, in terms of that so much investment been off the market? The danger is, again, that we're really going to get maybe tight in sort of another, 6 months, a year. But, it's huge money that's been taken off, trillions.
I would say in terms of capex, we're probably looking at half $500 billion this year alone. But having said so, we probably are likely to remain in this scenario for another 2 to 3 years. We're talking about where the price is. I'd say life begins at 40. That's how I would put it. And a number of the players in the market are viewing it as such. Anything above 50 would be a bonus. But that's the range they're operating at, whether we're talking capex or OPEX, beg your pardon, has a huge bearing on their thinking.
Indeed, let's look back at the year that's been, in a way. We started with the mid-30s, Bill, and the volatility that's been in the market. We've come down to 2025, around that price, 2026, and the volatility has been huge, and now we're looking at sort of a mid-40 level. Life begins at 40. I like that, and they're hoping it begins at 40 and will hopefully always continue to grow. But we've really experienced a period of huge volatility in the market.
Yeah, I think you can exclude some of the volatility. Most recently, we've seen a lot of volatility because it's very much linked to the headlines that are coming out about the very meeting that we're here attending. And that will, depending on the outcome tomorrow, should ease off a bit. But you're right, generally speaking, the market has not yet found its equilibrium, although there is some evidence to suggest now that, by and large, if OPEC were to continue the hands off the tiller approach, that you would see, prices between $40 and $50, say. But the question is, the extent, there's always been this year this expectation that a deal was in the pipes. And I think that's why we've seen quite a lot of headline trading and price volatility.
Jason, and that volatility, how harmful do you think it is at the moment? Or is it? It's just part and parcel of what we have to live with?
Yeah, I think it's part and parcel of what we have to live with. I mean, to be honest, the biggest swing in prices was when, we saw the price was low in the first quarter of the year, and it trended up through the summer, and then, you began to see a sell-off in July. And since then, we've been really choppy. It's been almost a relatively sideways movement rather than the significant trending we saw early in the year. And so, how we define volatility might be the question, but I think we're going to see choppy trading for a while. I think, no matter what happens, at this meeting, I think we're going to see some choppy trading. I think that, ahead of the summer driving season in the U.S., it's going to be choppy. But once the refineries come in at the end of February and they're buying the NYMEX contract rolls and they're buying crude oil for the summer driving season in the U.S., that should be supportive moving forward. And if that happens in a time period where the global economy, continues to, grow modestly, then that's going to likely prove supportive, especially at a period of high demand.
Gaurav, do you see that volatility, particularly the intraday volatility? That's probably where we're seeing more of it in the market.
I would say that the first 3 months of the year are going to be pretty tricky, adding on to what Jason just said. We'll probably, the first 2 months, the market will be watching out. We're trying to find a level where we can, work at. And that's why I mentioned life begins at 40. We will see extreme volatility, but I think we're also in for a period of calm once the first quarter has been safely negotiated.
Well, let's take a look ahead for that maybe hopeful period of calm. We can wrap this up. Bill, when we look ahead to the next year, what are the big challenges that we really need to be looking at for OPEC and for the oil market?
Well, if we assume that some sort of deal is produced tomorrow, I think then we will be looking at the implementation, delivery of those output freezes or cuts or whatever they happen to be. And we'll also be looking to see the extent to which producers default to a maximum output position. So that will be critical on the supply side. On the demand side, we've covered the points that Jason and Gaurav have made very well. The general picture is mildly positive, and it much depends upon emerging markets and how well they hold up as against the OECD countries.
So, Jason, for 2017, is it all about the economy?
Well, I think it generally, for oil, normally is. There's two things I've been telling my clients for years. And one is that the purchasing manager indices for manufacturing in the U.S., the Eurozone, and China combined, those are a really good leading indicator of price. And they've improved a lot in recent months. The second thing that I've seen over the last couple of years is that industrial metals prices have been leading oil prices. At times in the past, it was the other way around, but right now, metals have been leading oil, and they've been moving quite a bit higher. I think that's a good proxy for what's going on in China, and I think Chinese manufacturing is a good proxy for the global economy. And if you're beginning to see some improvements in warming there, regardless of what happens in the OECD, maybe in the first half of next year, I think you're going to see that emerging market demand be strong, emerging market demand improve, and oil demand growth rise.
Gaurav, I'll leave you the closing word on this.
I would say investment. If, as Jason and Bill have said, that we're talking about the Chinese economy showing some signs of a recovery, then how these particular IOCs and NOCs go down the investment route is what would be very interesting, because a number of final investment decisions have been put on hold.
So indeed, still a lot of challenges, but it's a new challenge every day in this market. So thank you again for sharing your insight and expertise with us. We really appreciate it. And that wraps up this edition of Oil Market Insight. A big thanks to Bill, Jason and Gaurav. Thank you so much for joining us. And stay with us, of course, on the OPEC website, where we'll be bringing you up-to-date news and views of what's going on in the oil market, and of course, full coverage of the 171st OPEC conference. Thank you.